Good morning, everyone. Happy Thursday. Shannon here with Fit for Profit. And today I am going live on Facebook, and then I will also post this recording to the YouTube channel. So if you happen to be watching it in any of those places, definitely leave a comment and let us know. And if you have any questions throughout, go ahead and post them. We can see the comments on Facebook as they're coming in, and then we'll come back and check YouTube after we post this. So today I wanted to talk to you a little bit about financial statements. And actually the question I got from a client this week was, why does the profit on my profit and loss statement not match the profit in my profit account? And so I wanted to tell you a little bit about what financial statements are, why they're necessary, or if they're necessary, and then how they work with Profit First. So it's actually a pretty complex topic, but I'm going to try to keep it really simple and pretty quick for you today. So what are financial statements? There are three financial statements that us as accountants like to talk about. The first one, and the most common for business owners, is called a profit and loss statement, or I like to call that an income statement. Those words are synonymous. They mean the same thing. And I like to call it an income statement because, well, basically because I don't like to call it a profit and loss statement. I feel like when we call it a profit and loss statement, we're kind of expecting a loss. And I don't want to expect a loss. So when I think about an income statement, it tells you how much income you had. It details that. And then it details where that income went, which is not completely accurate because it can go to other places than are what's shown on your income statement. But for the most part, that's where it's going to go. So that's the most common one. That's the one business owners know about and use most often because they feel it gives them the most information. And it does. However, there are two others that are also important to running a business. The second one, and I'm doing this in order of importance and that we look at them. The second one is your balance sheet. So your balance sheet details out for you all of your assets, which are things in your business that could be turned into cash or are cash. So your bank accounts are listed at the top of your balance sheet as an asset because they're cash. And then things like equipment, furniture, office equipment, all of that will be listed as an asset. If anybody owes you money, that is also an asset because you should be turning that into cash on a regular basis, right? Or maybe could sell it if you wanted to and have somebody else collect on it, but you would get cash for it. So things that could be sold, assets, equipment can be sold as well, sold to get cash. The next section on your balance sheet is the liabilities. This is money you owe to other people. So it could be current things if you owe money to your utility company because you got a bill last month and you haven't paid it yet. I mean, that's a liability. It's not wrong to have liabilities. It's not bad to have liabilities. Most businesses owe money to somebody. Now, if you owe money for like years to people, that's when we start to say you might have a problem in your business. But, you know, I owe money to somebody right now because I haven't paid my internet bill. I just got it yesterday, though. So it's just what happens in life. Timing differences, if nothing else. And then, so there's short-term liabilities and there's long-term liabilities. If you have a loan payable, those types of things, those are all going to be in your liability section. And then the very bottom part of a balance sheet is called the equity section. And this is what confuses most business owners, but basically it's the difference between the assets and the liabilities in your business. So your cash and what you can turn into cash minus your liabilities should equal, well, does equal your equity. So it's kind of what the business is worth to you. Not exactly. There's lots of different ways to value a business. So that's why we say not exactly, but that's really what you need to know about the equity section. If you are taking draws from your business, which most business owners should be taking some level of draws from your business. If you're a Schedule C business, an LLC, or a partnership, not a partnership. If you're a Schedule C owner, you would only be taking draws. So all of your pay to yourself would be as a draw. Partnerships would have draws. S Corps would have draws as well. So that will be shown in the equity section. And if you invest money into the business, if the business needs a cash injection, that will be shown in the equity section as well. So those two financial statements, your income statement and your balance sheet, are very important. The other reason the balance sheet is very important is because, remember I said on your income statement, it will tell you where your income, where it came from, and then what you spent money on. If you have loans in your business that you are paying on, the principal of those loans is going to be shown as a reduction on your balance sheet loan. It doesn't get shown as an expense on your income statement. So that's why there can be cash that comes into your business that is spent on things not on your income statement. For instance, if you buy equipment, that's going to increase your assets. It's not going to touch your expenses. So you really have to look at those two statements together at the same time in order to get a good picture of what's going on cash-wise in your business. The third statement is called a statement of cash flows. And quite honestly, most accountants don't know how to read it. It can take quite a bit of time to actually create that statement. And so most of us as accountants don't do it. And really, it is a compilation of the things that are already on your income statement and your balance sheet. So I honestly don't look at my statement of cash flows. I don't look at them for any of my clients. I haven't done one since college, probably, or public accounting days. So in 15 years. And that's okay. And I would say it's more important that you have profit first implemented in your business. When you have profit first implemented in your business, you really don't need a statement of cash flows. Your bank accounts become that statement of cash flows for you. So they will tell you, your bank accounts will now tell you how much money you have to spend on operating expenses and how much you have to pay yourself as the owner, how much you've saved for taxes, those kinds of things. So I don't think you need a statement of cash flows, but you do need an income statement and a balance sheet, and you should be looking at those on a regular basis. The balance sheet also, like I said, lists all of your bank accounts, and when those get reconciled on a monthly basis, then you know that your balance sheet is right. You also should be reconciling your receivables and your payables on a regular basis. I wouldn't say those need to be done monthly, quarterly, definitely annually. And if you have inventory, you need to be looking at that at least annually as well. So that's what the balance sheet and income statement are. Why is my profit on my P&L different from, I just said P&L instead of income statement, but why is my profit on my income statement different than my profit in my profit account? Because we are taking, for the profit first account, we are taking a percentage of all of your income and just putting it into that account. The income statement could have things like your pay. If you are an S Corp, your payroll will show up as an expense. So that reduces your profit, but it doesn't have anything to do with your profit bank account. It reduces the profit on your income statement, but it doesn't have anything to do with your profit bank account. There could be other expenses like that on your income statement where they're expenses for things that you pay that benefit you as the owner. So we really consider them owner's pay for profit first purposes, but it's a business expense. It's a deductible business expense for accounting purposes, bookkeeping purposes. And again, if you are making note payments, that will reduce the cash in your operating expense because those regular payments for profit first purposes are an operating expense, but they're not going to show up on your income statement as an expense at all. It's all going to go to your balance sheet to pay off that liability. So that's some of the differences between profit first and accounting, bookkeeping, QuickBooks, financial statements, whatever you're using to generate those financial statements. There are going to be differences. And I really just wanted to explain what a balance sheet and an income statement do, how you can look at those together to get a true picture of your story of your business, and then really the true picture, the true information, how you can make business decisions is based off of your bank accounts once you have profit first implemented. So like I said at the beginning, I know this is a very complex topic. Accountants spend a whole semester in college looking at what are these financial statements and how do they work together. So I just tried to do it in less than 10 minutes for you. I'm sure you have questions and we would love to answer them. So drop those in the comments below and we will be sure to do another live and do some Q&A on financial statements.